The stock market is a device for transferring money from the impatient to the patient. But before you hear that quote and start throwing your entire $10,000 into the market like a financial superhero, relax. Because saving your first $10,000 is not the finish line. It's not even the beginning of wealth. It's the moment the game changes. That's what most people miss. At $100, your money is survival money. At $1,000, your money is shock absorption. But at $10,000, your money becomes strategy. That is the shift. Because $10,000 is the first amount that feels big enough to do something stupid with. Now you can invest. Now you can upgrade. Now you can treat yourself. Now you can convince yourself that a luxury watch is somehow part of your financial journey. This is where people start making expensive, emotional decisions with money that took them years to build. And money does not care how hard it was to save. It only cares what you do next. So what should you actually do once you hit $10,000? Not one thing. That's the mistake. Most people want one sexy answer. Put it all in stocks. Put it all in a high-yield savings account. Buy Bitcoin. Start a business. Pay off everything. Keep it liquid. No, the correct answer is much more annoying than that. You assign your $10,000 a job because money without a job usually ends up unemployed in the dumbest place possible. A finance car, a fake emergency, a random investment opportunity, a vacation you call mental health, a house deposit you're nowhere near ready for. So let's break this down the right way. First, understand what $10,000 is not. It is not retirement money. Sorry, it feels big, but in the context of a 30-year retirement. It's a seed, not a forest. At an 8% annual return, $10,000 becomes about $21,500 in 10 years, about $46,600 in 20 years, and about $100,600 in 30 years. That's the power of compounding, but only if you leave it alone. And that's the problem. Most people don't ruin $10,000 with one giant explosion. They ruin it by giving it the wrong job. They use long-term money for short-term instability. Then life punches them in the throat, and they have to liquidate the future to fix the present. That's why the first job of your $10,000 is not make me rich, it's make me harder to kill financially. That comes first, always. History screams this at us. In 2008, millions of people weren't ruined because they lacked ambition. They were ruined because they had no margin, no cash buffer, no flexibility. Too many fixed costs, too much debt, too much optimism financed on monthly payments. Then in 2020, the market dropped around 34% in about a month. And suddenly people learned the difference between I'm investing for the long term and I need this money next week. Those are not the same sentence. So before you ask how to grow $10,000, ask this: how much of it needs to protect me first? Because if you don't answer that question, life will answer it for you, and life is very expensive. So here's the first move. Step 1, build a real emergency fund. Not a fake emergency fund, not 3 random months of vibes. A real one. If your monthly essential expenses are $2,500, then 3 months is $7,500. 6 months is $15,000. That means if you have $10,000 saved, there is a very real chance that most of it is not extra. It's just your first real layer of protection. That's not boring. That's powerful. People underestimate what cash does. Cash buys time. Cash buys calm. Cash buys better decisions. Cash lets you say, no, I don't need to panic sell. No, I don't need to swipe the credit card. No, I don't need to stay in a terrible job because one missed paycheck would end me. That is wealth in its first useful form, not visible luxury. Invisible stability. So for a lot of people, the smartest first move with $10,000 is simple. Keep enough cash to cover 3 to 6 months of essential expenses. Yes, that means part of your precious $10,000 might just sit in a high-yield savings account. Good. Let it sit there. Your emergency fund is not supposed to impress anyone. It's supposed to keep your life from catching fire. Now, once that part is handled, the second question is debt. Because there is no point trying to earn 7% in the market while paying 24% on a credit card. That is not investing. That is financial cosplay. If you have high interest debt, usually anything above about 8% to 10%, and definitely credit cards in the 20% range, your money has a better guaranteed return by killing that debt. A guaranteed 24% return from eliminating credit card interest is better than a maybe 8% market return every day of the week. No hedge fund in the world beats math that simple. So now we already have the first real decision tree. If you hit $10,000, first protect the downside, then kill the expensive debt. Then think about growth. That order matters. Because the market can help you build wealth, but it cannot rescue bad structure. Let's say you have $10,000 saved, $4,000 in credit card debt at 22%, and monthly expenses of $2,000. The smart move is not YOLO the whole thing into an ETF. The smart move is more like keep enough emergency cash so life doesn't own you, wipe out the toxic debt, then invest the rest steadily. This is where adults separate from financial tourists. Tourists want the exciting answer. Adults build the boring structure that lets exciting outcomes happen later. Now, once your emergency fund is decent and your high interest debt is either gone or under control, then yes, investing enters the chat. And this is where people get weird again. Because $10,000 tricks your brain, now it feels like you need to make a big move. But the smartest move is usually not a dramatic move, it's a repeatable move. For most people, that means broad, low-cost index funds. Not because index funds are sexy, they are not. They are the oatmeal of investing. But oatmeal works. Over long periods, the S&P 500 has averaged roughly around 10% a year before inflation, though individual years can be a circus. Some years are amazing, some are ugly. Some feel like the market got drunk and started texting its ex. That volatility is the price of admission. So if you're putting part of your $10,000 into investing, the real question is not, what will make me rich fastest? It's, what can I hold through panic without becoming an idiot? That is the real investing question. Because a perfect portfolio you abandon in fear is worse than a boring one you stick with for 20 years. And by the way, this is where taxes matter too. If you have access to tax-advantaged accounts, retirement accounts, employer matches, the equivalents in your country, use them intelligently, especially employer matches. A match is one of the closest things in life to free money. When your company says, we'll match your contribution up to X%, that is not a suggestion. That is a giant sign saying, please, pick up this money before we keep it. So once you have your cash buffer and debt situation under control, your $10,000 may need to do 3 jobs. Part protection, part cleanup, part growth. That's the adult version, not 100% in one bucket. Now let's talk about the dumb stuff people do at $10,000 because this is the fun part. Mistake 1, upgrading the car. People hit $10,000 and suddenly start acting like their current car is a war crime. Then they trade a functioning vehicle for a bigger monthly payment. Congratulations. U-turn save money into future stress. Mistake 2, using it as a down payment before you're actually ready. A house is not just a monthly mortgage, it's closing costs, maintenance, repairs, furniture, things breaking at 11:48 p.m. on a Sunday. If your $10,000 is all you have and buying a home would wipe you out, you are not buying stability. You are buying a highly leveraged stress machine. Mistake 3, starting investing with no plan. They dump all $10,000 into a hot stock, crypto, or some next big thing, then watch a 30% drop turn them into philosophers. Suddenly they're posting, money isn't everything. Maybe wealth is really about experiences. Maybe the real portfolio was the friends we made along the way. No, you just gambled because the amount finally felt big enough to gamble with. Mistake 4, letting it rot in checking. Now this one is sneaky, because yes, keeping cash matters. But keeping all $10,000 in a checking account, earning basically nothing for years, while inflation slowly eats it alive, is also lazy structure. Cash needs the right container. Emergency cash in a high-yield savings account. Good. Long-term money in investments. Good. Randomly all sitting together doing nothing. Bad. Your money should not live in one big, messy roommate apartment. Each dollar needs an address. So what does a smart split actually look like? Here's a simple example. Let's say someone has $10,000 saved, no toxic debt, monthly essential expenses of $2,000, and no investing started yet. A reasonable setup might be $6,000 in emergency savings, $4,000 into long-term investing. That's not universal, but the logic is. Or maybe $5,000 emergency fund, $3,000 pay down medium interest debt, $2,000 begin investing, also reasonable. The point is not the exact ratio. The point is structure. Now, if you already have a solid emergency fund and no bad debt, then $10,000 becomes much more powerful. Now you can deploy it. Invest more aggressively, max retirement contributions, build a business runway, create opportunity capital. That's where things get interesting, because once your downside is protected, money stops being a shield and starts becoming a weapon for optionality. That's the real goal. Not just, I have money, but I have choices. I can leave bad work. I can survive a bad month. I can invest without panic. I can take a career risk. I can say no. I can breathe. That's what $10,000 can start to buy if you use it properly. And if you use it badly, it buys a temporary dopamine spike and a longer monthly payment. Now here's the gray area. There is no magical line where $10,000 automatically changes your life. If your expenses are high, if your debt is ugly, if your income is unstable, then $10,000 is a foundation, not freedom. But that's still huge, because foundations are what keep buildings standing. And most people are trying to decorate a house they haven't structurally built. They want the kitchen upgrade, the luxury vacation, the investor identity. Meanwhile, the floor is made of cardboard. So what should you do once you have $10,000 saved? You make the most boring, high IQ decisions of your life. You protect. You simplify. You eliminate high interest drag. You assign roles. You invest what can stay invested. You keep the structure strong. Because wealth is not built by dramatic money moves. It is built by repeated smart allocations. And $10,000 is the first point where that starts to matter. That's why this number is so important. Not because it makes you rich, but because it reveals whether you think like a spender or like a builder. A spender sees $10,000 and asks, what can I get? A builder sees $10,000 and asks, what can this money do for me for the next 10 years? That is the difference. And that difference compounds. So here's the final thought. Once you have $10,000 saved, do not celebrate by weakening your position. Strengthen it. Use part of it to protect your life. Use part of it to clean up your balance sheet. Use part of it to build your future. Because the first real power of money is not status. It's stability. And the second real power of money is not excitement. It's options. And if you get those two right, then one day, almost by accident, $10,000 turns into a lot more. Subscribe for more simple, animated finance videos.